Hi guys, good evening. Let's just get started quickly as possible. Let's see what you can cover for today. So, yesterday we stopped yesterday we stopped at margin call, right? We stopped at margin call. So, if you have watched the video as the yesterday's video, you know that we stopped at margin call. So, today, of course, I do want us to finish this at least for this week. So today we'll be talking about leverage, right? That's what we're talking about today, leverage. Now, the question is, what is leverage, right? That's the question I'm going to start with. What is leverage? So let's see how far we can cover. So now, I don't know if I should write that down here, but let me see if I can just write that here very quickly. Okay, let me do it on the trading view, right? So we're still on the key concepts in trading, right? We're still on the key concepts in trading. So let me just take that down here. Okay. So, as I said, we are still in the key concepts in trading. Now, so today we're actually talking about a lot, but what we'll be starting with is leverage, right? So this is our first topic for today that we'll be talking about. Now, the question is, what is leverage, right? What is leverage? Now, so let me just use a very small tool. Now, leverage is an amount of money that the broker, I'm going to explain what a broker is, borrows you to do business as at be to it is an amount of money. So let me put it there. So leverage is it is an amount of money. Sorry, money. It's an amount of money that the broker borrows you to do business as at that particular or as at that time, and whether you make profits or you lose or loss, comma, then you get to give them back their money because they are borrowing you. You get to give back their money and walk away with your profits or losses. I think this is really self-explanatory, right? For what leverage is. Yeah, I think this is very self-explanatory. So leverage is the amount of money. So let me just cover that. Okay, so leverage is the amount of money that the broker. Okay, now a broker is just like a bank, right? So where you deposit your money, where you withdraw your money. But this broker now, it serves as a like a bank in trading, in the trading industry, right? It serves as a bank that gives us the retail trader the access to the financial market, right? So is this broker now you are going to you will there are different brokers, right? There are different brokers out there. So there are criteria they need to check to select a very good broker. So now this broker is just like a bank. It's where you're going to put your money, right? It's where you're going to withdraw your money. So whether you make profit or lose, it's still from the broker, right? After you have traded, so your profit or loss, or like you deposit your money, you withdrawing your money to trade is directly doing it in the broker or under the broker, right? So you're directly doing it under the broker. Now, as I said, sorry, leverage is the amount of money that the broker borrows you. The broker, when we reach the trading platforms we'll be using, you really understand what a broker is. So, but I'll explain more about that in depth later. So now, leverage is the amount of money that the broker borrows you to do business as at that particular time, right? As at that time, they are borrowing this money to do business, and whether you and this leverage is only when you are opening or close, or when you're in a trade, right? So if you're not placing any trade, it's just there, right? But the moment you place a trade, right? So there's a way you are going to set it. I'll explain that. I'll do a video that covers that. But just have it in mind that leverage is the amount of money, right? It is an amount of money that the broker borrows you to do business at that time. And whether you make profits or you lose, right? Then they get to keep back, like you get to give back that money that they borrow you and walk away, whether you make profits or you lose, right? So let's say now let's give an example of a broker. Now I think I'm going to use a layman's way so that to be very, very easy to understand. So let's give an example. Let me write that down here. Let's give, I don't know if this is necessary, but let's give an example, right, of leverage. Now I want to give an example of what leverage is. Now, I want to give a layman way so that you understand it, and then I'll bring it in regards to trading as well. So now the rule, right, is when you want to get a loan for a house, right? So like when you want to get a loan now so that you can be able to buy a house. The number one rule is you need to drop at least 20% of like down payment, okay, of the cost of the house of that property in order for you to purchase that property. Now, let me give an example. Let's say you want to buy I'm going to use dollars. I don't want to use naira here, but it's still the same thing, right? It still applies. So, but for easy understanding, you can use that. So, let's say there's a property. I don't know if I should draw, if I should draw a property here. So, let's see if I can just do that very quick. I don't know. Don't mind how my drawing is going to look like. So, let's say this is a property, right? So let's give an example. This is a property, guys. Don't mind me. I'm not really good at for now. But I was good then. Right? I was very good then. So let's give an example. Let's say this is a property, right? I'm not supposed to reach much time here, but so learning. So let's say this is a property, and let me just use this here. Right? So you can be the door. Right, so the window, anyhow, you just understand this. So let's say this is our property, right? So we indicate that as our property. I'm just giving this in the mind so that everybody can understand it, right? So let's say this is our property. So I'm going to try to be fast in this so that we can cover up the what we have today. And now this property, right? This is our property. And now this property, let's say it costs $100,000, right? So let's put that here, $100,000. That's the property cost. So let me put property costs, right? So let's say this property costs $100,000. Now, the number one rule, I don't know if I should really write that rule here, but let me see if I can put that down very quickly. So the rule is when you want to get a loan for a house, you need at least, okay, you need 20% down payment, on that property in order to purchase the property. So this is the rule, right? This is the rule. Let me put that here very big. So this is the rule here, right? So this is the rule. Now the rule is, right? The rule is when you are buying a property, right? When you're buying a property, the rule is you like what I mean now is so what I wrote here is the rule is where you want to get a loan for a house, right? Let's say you want to buy a house now. If you don't have the complete money, the way you can purchase that house is you dropping a down payment of 20% of that amount of money that the property costs, right? So that's how the rule is. So the rule is when you want to get a loan for a house, you need 20% down payment on that property in order to purchase that property, right? So you need to drop at least 20% so that they'll know that, okay, this person is really serious and really want to buy this property. So you need to drop 20%. Now, this is the property, right? This is our property. And then the property cost, right? The property cost is $100,000, right? It's $100,000. Now, the down payment, right? The down payment, which you are going, that is 20% of 100,000 should be $20,000. So that's 20. So if you don't know how to calculate this, you can just say 20% or 20 divided by 100, right? You can just say 20. So then I don't know if I should really write that down. But if you want to get 20%, right, all you just need to do is 20 divided by 100. Sorry, divided by 100, right? Then you times it, what you get, which will be like 0.20. Then you times it by the amount, this thing, the total distance. So what you are going to get here, right? What you will get here will be equals to 20,000, right? So that's what you are going to get. So this not calculate, just divide that percent, 20 divided by 100 times the amount, you're going to get the 20%, right? So the 20% of 100,000 is 20,000, right? And now this is our property, and our property costs $100,000. Now, the rule is you have to drop 20%, and 20% of 100,000 is $20,000, meaning that this um people that is going to borrow us this money, right? They are asking us to drop 20%, which is we're going to do a down payment of $20,000 so that when we bring the remaining money, we're going to collect the property, right? That means the property is really going to be our own completely, right? It's going to be ours completely. But now, so let's give an instance of maybe, let's say this money you're borrowing from a bank, right? So now, take this bank. Now, I'm using bank in regards since I'm trying to explain this in a layman's way. But in the forex industry, it's known as the broker, right? It's known as broker because if you read here, leverage is the amount of money that the broker borrows you, right, to do business, right? So it's the broker that is borrowing you this money. But now, since we are giving it in a layman's way, right? So let's say this broker is our bank, right? So it's our bank now that is borrowing us this money. So now, let's say, for instance, it's the bank that is giving us this money, right? So I don't know if I should really put banks here. But, so this is our bank, right? Or bank, right? So this is the bank that is giving us this money, that is giving us this, that is going to borrow us this money for us to be able to purchase this property that costs $100,000, right? So now what these banks are going to do is that they are going to take this your $20,000, right, which is 20%, right, which is 20% of that 100,000. So they are going to take this $20,000 and give you $100,000. Please listen very carefully. Now, this bank are going to take this your down payment of 20% because you are coming to collect loan for them. So um you need to drop at least 20%, which is the rule, right? So now this 20%, which is $20,000, is what you're going to give the bank, right? The bank are going to take this $20,000 and give you the $100,000 as the loan, right? They're going to give you this $100,000. What, like, that's this $100,000, that is cost of this property. That's what the bank are going to give you. So, and let's give it in an example that is these banks that own this property, right? They own the property. So let's give it the example that way, that the bank own this property. So they will collect this your $20,000 down payment, right, and give you this property that costs 100,000 because you want to purchase the property, right? So they are giving you this $100,000 piece of property, right? So let's say this is our property, and this property costs $100,000, and now you are coming to the bank, right? And the bank say, okay, if you want this property, what you are going to do is you are going to drop 20% down payment so that it will show us that you are really serious and you want this property, right? So you are going to drop 20%, 20% of the total cost of that property, which is 100,000. You are going to, that means it means you are going to drop 20 percentage, $20,000, which is the 20%. And this bank are going to give you this piece of property that costs $100,000, right? So now this bank as will now say that this piece of property, you can hold it as long as you want. Right now, this property that costs $100,000, which the banks have given you, what they are trying to say now is that you can hold this property, right? You can hold this property as long as you want. You don't need to make any payment on this property, like maybe issue or anything. Just their own is they are giving you this property so that when you get the complete money, you can balance them, right? So they're giving you this property that is worth 100,000 based on your down payment of $20,000 they have given them. Right? So they give this property. And now what these banks are saying is that you can hold this property as long as you want. You don't need to pay any money on it. Right? You don't need to pay money just because you're holding this property. No, because of that down payment, it has covered you to be able to hold this property for as long as you want. Right? But when now the bank say but anytime you decide to sell this property, right, you still owe them 100,000. I don't know if you understand. Now, the rule is you drop 20 percentage of the total amount of the cost of the property, right? And now, this is the banks. Bank I say you have to drop this 20%. 20% of 100,000, which is the cost of the property, is $20,000, right? It's $20,000. Now, but these banks are saying that since you are dropping this down payment, they are going to give you this property that is worth 100,000, and you can hold this property as long as you want without making any payment on it, right? But anytime you decide that you want to sell this property or you decide to sell this property, you still owe them 100,000, right? You still owe them 100,000. So that means now let's say the housing industry, right? That's the market of like the housing property. There's way for instance, like real estate, all those things, when there's the high demand of it in the market, the thing begins to go up, right? The price of property begins to go up. But when there's no demand again of properties, the market begins to crash. That means the price keeps on dropping. So let's say the housing property crashes, right? The housing property crashes, and this house, right? This property that costs 100,000 naira drops, right? That means because now somebody is not able to buy this property at the cost of 100,000 because people are no longer in demand of properties again, right? And the market of the housing industry or housing property drop, right? The banks are still saying it doesn't concern them. You still owe them $100,000, right? You still owe them 100,000 anytime you decide to sell it, right? Anytime you decide to sell that property, you still owe them 100,000. That is what these banks are saying, right? I don't let me still repeat myself again. Now, after these banks have given you this piece of property that is worth 100,000, they are saying that you can hold this property as long as you want to hold it. But anytime you decide to sell it, you owe them $100,000, right? You owe them $100,000. Now, that is to say, if the market price or the housing property market crashes, right? If the market housing property drops, right? Let's say it drops like crazy, for instance, you still owe them, what this bank are saying, you still owe them 100,000 whenever you decide to sell the property. You still owe them 100,000. And let's say when the housing property now decides to go up, now there's now high demand of, like the market now keep on going up instead of crashing, now it's pumping, right? The market, the housing property is pumping, right? People are in demand of it, right? And vice versa. Now, what these banks are still saying is that you still owe them $100,000. So whether the market of the housing industry goes up or it crashes, you still owe them $100,000. It's as simple as that, right? It's as simple as that. So now, let's also give an example. Let's say this housing property, right, drops, right? It crashes and it dropped like 50 percentage. Like let's say we're 100 bar. So let's say the housing property drops to 50%, right? And you decide to sell, right? So this is our cost of the property, right? $100,000. Now um the housing property drops 50%, right? It drops 50%. So this is So the housing property drops 50%, right? Now, if this housing property have dropped 50%, it means that you just lost $50,000. That's really what it's saying. You just lost $50,000. That's if you decide to sell, right? So they give you this property that's worth 100,000, and now the market, the housing property market crashes 50%, right? It means that, and you decide to sell, you just lost $50,000, because 50% of $100,000 is $50,000. Guys, it's $50,000. Let me write that down here. It's $50,000. You just lost freaking $50,000 just for selling the property where after the market crashes 50%. But now, what if, let's give an example, right? Let's give an example. Let's say this property now, right? This is an example of if it drops like 50%. But what if this property goes up 50%, right? What if this property goes up 50%, right? So let me just put that here. So let's say this property, um, so let's put plus here, 50%. If you really see that well, let me just delete that. So type that number. So plus, let's say 50%, right? So let's say this property goes up, which is plus $50,000. We just made a profit of fucking $50,000 on this property, right? Without doing anything, just for you holding it. So now, as I said, if the cost, the property, housing property or property industry drops 50%, right? And you decide to sell, it means that you just lost $50,000, guys. Just lost $50,000. But if the property goes up by 50%, right? If it goes up by 50% and you decide to sell it, it means that you just made a profit of $50,000 on top your $100,000 property. But sorry, but remember, you still owe the bank $100,000. Have that in mind. You still owe the bank 100,000. So let's say at this point where the housing property drops 50% and you decide to sell and you lost $50,000, guys, you still owe these banks $100,000. You still owe them, right? But if the housing property increases, let's say it increases 50%, that means you have made a profit of 50% when you sell, right? So if you sell, for instance, you are now going to get about $250,000, right? So, but remember, still have it in mind that you still owe this bank 50, you still owe this bank $100,000. So you need to always have that in mind, right? So you need to always have that in mind. So now I hope this is really clear about leverage. It's not really that hard, right? I'm going to now try to relate it into trading a little. So this is really what leverage is, right? So it's the amount of money your broker borrows you to do business as at that time, and whether you make profit or you lose, which I explained, the 50% increase or decrease, you get to give them back the initial money that they borrowed you, and you take it, you go away with your profit or your loss. So if you were doing the cost property, this property cost, and you decide to sell when the price went down to 50%, you decide to sell, have it in mind they are still going to give that bank their $100,000. It doesn't concern them when you're going to get the remaining 50,000 to give them, but you're still going to give them that $50,000, then that $100,000. Why, if the market price goes up 50%, which you'll be having 150%, right? And you remember, you still owe that bank 100,000, so you need to see refund them back that 100,000 and go away with your profit, right, or your loss, depending. So now there are different leverage that different brokers allow you to have, right? I don't know if I should also write that down here. I need us to do fast, but this is quite interesting. So there are different types of leverage that, I don't know if this leverage is understand, but you understand that brokers allows you to have, or allow you to have, whichever one the English could be. So Now there are different this thing, right? There are different types of leverage that different brokers allow you to have, right? So I'll just give a few examples, right? Let me just leave them very quick. So the examples of the leverage we can have is like, let's say 1:20. In fact, you can even have 1:10, 1:20, 1:30, or let's say 1:50, 1:100, 1:500. Most content are actually restricted to have a large number, a large distance of leverage. You can have 1:1000, you can have 1:2000, even 1:3000. Guys, even up to unlimited, right? You can have unlimited as well. Like there are brokers that give you this leverage to have unlimited this thing, unlimited leverage, right? It can allow you. Now, so now you can see at this point, like this level that we explain, right? These bankers or this bank, they gave you this buying power to be able to purchase this property of $100,000, right? They gave you this buying power. It's not like um that maybe if for you having this 100,000, you're not able to buy the property. No, just because of this down payment that you have dropped, they give you this trading power or this buying power or selling power to be able to purchase or sell this property, right? At with your small amount of money, like just a little amount of money that you dropped, which is $20,000, you're able to control this property of $100,000. So you can see how leverage can be very, very helpful. So with leverage, right, you can use a little amount of money to make, and that little amount of money will magnify a whole lot of profit, right? With your little amount of money that you can use to magnify a whole lot of profit. Why still this leverage that can be a very good thing can also be a bad thing as well, because you can also lose very quickly as well. So you can increase the potential losses as well, right? It can increase your potential losses. So in as much that leverage is a good thing to help you to be able to make more profit, right? It can also allow you to lose a lot of money as well. So always keep that in mind. So what this simply means now is that you have an account, let's say an S amount of leverage, depending on the leverage you have, and then you have having or you're getting a buying power, right, on that amount of money that you deposited initially. So let's say our account balance, right? I just want to really quick and show this. So let's say our account balance is 100. Okay, let's say our account balance is $1,000, right? So we're holding an account balance of $1,000, right? So now let's say the leverage why I don't know if I should really okay. So this is what we're going to do. We're going to do something like this. So I'm not really going to do for all of them, but you should be able to understand, right? Should be able to understand because I don't want to really cover up something very quickly. So let's do for 50 as well. So let me do for, let's say 2000. So guys should understand what this means when I'm explaining it. Because now they are giving you this buying power, right? They're giving you this buying power. This is what leverage do, because now you can see I say it's the amount of money a broker borrows you, right, to do business. So that means they're giving you this power to be able to purchase or even do business with just little amount of money that you are putting to be able to do business or control something that costs even 10 times the initial amount that you put, right? Right. This is what broker allow you to do or leverage allow you to do as well. So now this is a leverage of 1:10. This is a leverage of 1:20. This is a leverage of 1:50. This is a leverage of 1:100, 1:500, 1:1000, 1:2000, and so on and so forth. Now, let's give an example, right? Because these are buying powers. So now for you to be able to have a buying power with a $1,000, right? You on a 1:10 leverage. I don't know if you understand. On a 1:10 leverage, which is this 1:10 leverage, right? You have a buying power or a purchasing power or a trading power of $10,000. So let's say 10,000, uh, just have like 10 minutes, guy, of 10,000 buying power. Right, so you have this thing of 10,000. Well, let me see how quick I can finish this leverage. Because for me to explain this, guys, it takes time. So now, how you be asking me, how did I get this $10,000 or 10,000 buying power? Now, our initial account balance here is 100,000. It's $1,000, right? $1,000, and we're using a leverage of 1:10. Simply, what you are going to do to be able to know the buying power or the trading power you have, right? Based on this thing I explained here about leverage, right? You are dropping down $20,000 for them to give you a purchasing or a trading power of $100,000, right? So now, in the real aspect of it in trading is that when you have an account of $1,000, which is here, our account balance is 100,000. Now, and you are using a leverage of 1:10. It simply means that you are going to access a trading power of $10,000 with just $1,000 in your account. You have a buying or a selling power of $10,000. How? Right? That's what you're asking me. How? Now, simply what you are going to do is to times your account balance times your leverage. That is to say, what you are going to do here is you are going to say 100,000, right? So what you are going to do here is you are going to say 100,000, sorry, you are going to say $1,000, right, times 10, right? Because this is our 10, and you're going to get equals to $10,000, right? You're going to get $10,000. So if you decide to do for leverage of 1:50 and your account balance is 1,000, it's 1,000 times 50. You're going to get a trading power or a buying power of $50,000. So you can see with your $1,000, you are able to get a trading power that is even way more larger than the initial account balance you have. So let's say still our initial balance is 1,000 and you're doing a trading power of $2,000 of 2,000, that is 1:2,000, right? It simply means you are able to access this market of 2 million trading power, guys. 2 million. So you can see with this, you can even use this to, you can see with your little amount of money, you can access a large capital, right? You can access a large capital as well. So this is what leverage allows you to do. So it allows you to also, I think I wrote something. Let me just explain that quickly. So this is what leverage is, right? Maybe with time we're going to really talk more on leverage because we just have like few minutes. So let me go back to this point. Right, so this is what leverage is. I've given an example. So while leverage can magnify profits, it also increases potential. It also increases the potentials for losses as well. So have this in mind, please. If you don't understand, you can watch this over and over again. Now what I want us to talk about, let's see how many minutes we have, like 6 minutes. So now I want us to talk about this one now, the bid and the ask price, right? The bid and ask price. Now, the price, what is bid price? Bid price is the price at which a market maker is willing to buy a currency pair. Ask price, the price at which a market maker is willing to sell a currency price. And now the third one is the difference between the bid and the ask price is known as spread. So let's see what we can cover with this little time we have, right? Let's see what we can cover. Now we're talking about the bid and the ask price. Now let me zoom this. I want you to see something, right? And when we start maybe trading, you are going to really understand this more and more. Now you can see this red line here, right? You can see this red line here, right? So let me do that here. This red line here, right? I know you can see it. So if you can see this red line here, right? And then you can see this other line here. Let me use this. Let me use the dark color. So you can see this blue line as well, right? Now, when you are placing trade, this one here is called the bid price, while here is called the ask price. The down one here, which is the blue one, is called the bid. It can be any color, but mostly red and blue. So the down one is called the ask price, while the up one is called the bid price. Now, they say the bid price is at which a market is willing to buy a currency pair. Now, when you place a trade, right, anytime you place a trade, you always notice, right, that you're always in loss. The moment you place a trade, you automatically be in loss, right? Because when you place a trade, right, let's say you are entering for a buy, right, and you place a trade. Now, your trade will start when you place a buy, your buy will start from this point here, which is the bid price. Now, this way your buy will start from, right? So even if the current price of that market, let's say the current price of that market is around this point, right? For instance, let's say the current price of that market is around this point, but we have our bid price here and our ask price down. When you buy, when the price is at this point, what so when the price is at this point, right? What will simply happen is that your buy will start from this point here, right? Let's say the price is at this point bar, and then you enter for a buy. When you enter for a buy, your buy will start from here. This way your trade will place from this point. So you automatically see yourself in loss. And before you start seeing yourself in profit, is when this blue line, right, have come up above this where your buy starts from. I don't know if you really understand this, right? Until this blue line now comes above this line that you initially bought from, because as it's moving, the ask and bid price are moving as well as the price is moving. So this is our bid price, this is our ask price. So when you buy, right, when you buy, your buy will start from here, because here will be where the current price is. When you buy, your buy will start from here. This way you're going to enter, this way is going to trigger you that you have entered the market for a buy. So automatically you already see yourself in loss. Now, before you see yourself in profit, is that this ask price here, right, this blue one will have to come above this your entry here where you bought from. That's when you start seeing yourself in profit, right? That's when you start seeing yourself in profit. So same thing with sell. Now, let's say the price is at this point, right, for a sell. So let's say for a sell now, because now I want to talk about the ask price. So, and you're selling. Now, when you sell, right, your sell will start from here. Here will be where the price will be, right? So, but when you sell, your sell will now move from here, and your sell will start from here. This is where the current price will be when you're selling, right? This is where the price will be. But when you place a trade for a sell, your sell will start from here, right? Your sell will start from here, and automatically you'll be in loss. Now, before you be in profit, this bid price will have to come at least past this blue line, or past your initial entry, before you start seeing yourself in profit. This is for a sell. Please watch this thing again. Now, let's say we're selling, right? I want to talk about the ask price now. Now, the current price will be here at this point. Since we're selling, the current price will be here, right? And then here will be your ask price. Now, when you enter a sell, automatically you see yourself in loss. Now, before you can see yourself in profit, this entry here, which is this red line here, sorry, will have to come past this your entry, your sell entry, right, which is this ask price. You have to come and pass it before you start seeing yourself in profit. So vice versa, just watch it, you understand again. Now, the distance between, right, just have like few seconds, the distance between this point and this point, that is the distance between the ask and the bid price, is what we know, what is called spread. Now, the distance between this small space, you can see this small space they are seeing here. So the distance between this bid and ask price is called spread. Now, what is spread? Spread is the amount of money your broker charges you for every trade you place. Spread is the amount of money your broker charges you for every trade you place. So guys, please watch this video over again. You need to understand. I think this is where we're going to stop for, because we just have few seconds to the time, right? We just have few seconds. So as I said, please reward the video so you understand this ask and bid price. I know I rushed it, but there was no time. And remember again, distance between the ask and the bid price, or the bid and the ask price, is called spread. What is spread? Spread is the amount of money your broker charges you anytime you place a trade. That's why mostly anytime you place a trade, you automatically see yourself in loss. Now, this is where we're going to stop for today. So tomorrow we're going to continue as well. So before you watch this video, which is part 10, please make sure you come to this YouTube channel and watch these other videos. You have part 1, part 2, part 3, up to part 9. Right, so yeah, if you really like this content and you like what we're doing, please subscribe to this channel and share with your friends, comment as well. Right, for my YouTube community, this is for you. So if you like this content and you want us to continue bringing more of this, please don't forget to like, share, and subscribe. If you like, in another way you can Another way you can promote us or help us is by donation, or if you